Okay, so this is getting into the specific kinds of things we can do to generate a risk management plan using other insurance. So here's major types of insurance coverage. So there's three broad categories: property and liability, personal, and government. Personal liability, property and liability, and personal both come from private insurance companies, and then obviously government does not. You can see there's and we're going to talk about each of these boxes, right? So under property and liability, we have home insurance, auto insurance, umbrella policies, which cover liability, like broad personal liability, and then an injury like on your property, and then liability coverage. And then personal insurance, life insurance, disability insurance, long-term care insurance, and health insurance. And then government insurances, unemployment insurance, workers' compensation for injury and disability on the job, Medicare for health, late in life Medicaid for the low income medical insurance, and then Social Security, a cash benefit for older retirees. So, first, property insurance. So property insurance covers both real and personal property related to the home. For example, I had a fellow grad student buddy. So we all shared an office, and we weren't very good about leaving our office door locked. And somebody wandered into our shared PhD offices and stole his Apple laptop. And so, and this was in 2000 and, oh gosh, what would this have been? 2008, 2007, maybe even 2006. And so, I mean, Apple laptops are not cheap now, but they were really not cheap then. And, but he was able to file an insurance claim under his homeowner's policy. It covered theft of his personal property, even not at home. Now, that doesn't always happen, but if that's on your policy, then you could file a claim. So, it depends. Right, each different policy has different coverages. So, you have real property, which could be the dwelling itself, or other structures that are on the land that aren't. So you might have for a pole shed or a garage or something that's also on the property, but not attached to the dwelling. That would be separately insured, and then personal property. So originally you would, right? So if you go back far enough, right, you have each individual possible risk insured along each individual property, but now they're usually combined into a single policy, and there's different types. So these are the major ones. This is homeowners type 1, 2, 3, 4, 5, 6, and 8. So they have these big titles. So homeowner 1 is called basic coverage, and it's HO1 basic coverage. It's less comprehensive and not always available. So this is sort of like the minimum. Often, right, if you have a mortgage on your home, which almost everyone does, the provider of the mortgage will require insurance on the property. So if you want to get a mortgage, you're going to need to get insurance, which means you're going to need to get insurance. And it's possible that HO1 would be sufficient for covering that requirement, but doesn't, just because it's possible, it might not be, and even if it is, it's not necessarily a good idea. But that's the most basic of coverages. HO2 is broad coverage, and that has separately stated risk coverages. So I'll say, okay, these are the things that it covers, these are the things it doesn't cover, so it'll be stated which risks are covered and which risks are not. HO3 is the most popular, and it covers more risks than 1 or 2. It doesn't cover broadly everything, but the idea is that you've got a large swath of different risks that it covers. So it's called special coverage, but right now HO4 is tenant insurance, and it's it's a tenant type of insurance. It's basically you probably have heard it marketed as renter's insurance, and the idea is that you have personal property that you're insuring, but you're not insuring your dwelling because you don't own it and you have no loss, right? So your loss is to the personal property in there. So and again, right, a homeowner's policy will cover personal property as well. So it's kind of like you're buying the personal property part without buying the house part or the outbuildings part. So that's HO4. HO5, comprehensive coverage, is like HO3, but you have HO5 is, instead of having named perils, it generally provides open perils or all risks coverage on personal property. So these are right. In a sense, you're not. HO5 is much more broadly applicable to risk, to much more broadly applicable to different types of risks, and it's not so much having every you don't have a list of all the things that it does. It's supposed to be broadly more flexible and just cover you generally. So that's it's called comprehensive coverage because the idea would be comprehensive to lots of different types of risk. Instead of, right, if you have named ones, the idea is that if it's not named, you don't get it, and they're deliberately not naming some stuff. And that's true even for HO3. So HO6 is for condominium and cooperative, right? So if you own a condo, you own your unit, but there's also some shared response. For example, you are not responsible for the roof, right? You probably pay an HOA fee, and then the HOA replaces the roof when it needs to be replaced. And so you don't have any interest and therefore are not insurable if there's like a hailstorm, right? So the hail comes, damages the roof, you have to replace the roof. That's not a loss to you because you pay into reserves, and so that loss was to the condominium management organization, right? So you just have so basically, because insurers don't need to cover all those shared spaces, they're only covering your dwelling, but you do own it, right? You own this condo, just not all of these shared things. This is just different, right? So you get the HO6 is a separate policy specifically for that purpose. I remember as a 19-year-old, I didn't even know what a condo was. I was visiting somebody in San Diego, and I said, "Oh, your apartment's really nice," and they said, "Oh, it's not an apartment, it's a condo," and I just thought, oh, well, that's the same thing, right? I had no idea. So I found out later they were just like, expressing that they owned it and weren't renting it, as if that wasn't a very important distinction. So, which I think it was in San Diego because there's a big price difference. So the last is HO8, so that's homeowner, and this is modified coverage, and the reason it's modified is because you might have a home whose replacement cost is greater than the fair market value. So let's say you buy a historical property, and you could build any old house in there for $200,000, but that house has is like an $800 or $1,000 house, not by square footage or by any other metric other than it's like special, right? So you would so that obviously has to fall under special coverage because in a way you're kind of you're on the border of violating the skin in the game clause, right? It's kind of like you've got this $200,000 property that you're insuring for $800,000, but then you have a really specific reason for why that so basically you can navigate that and these policies exist, but you have it gets its own special treatment basically. So there's lots and lots of different types of homeowners and property insurance for different situations, and that will affect depending on the risk management situation for your clients, you may recommend a different numbered version of that, right? Additionally, we have different property types, right? So A is the dwelling itself, B is structures not in the dwelling, C is personal property, and so on, right? So you have all these different coverage types, and you can right, and we can have different policies with respect to of each different type of property, right? So you could maybe say, well, we're getting replacement value on the house, but we're only going to do liability on the outbuildings or something, or it might just specify which property types are covered and which are not. So so all of that is part of, right, the more property types and the higher and the more the coverage covers, the higher the premiums. Also important to note is that so first of all, the actual cash value uses replacement costs but takes a depreciation into account. So let's say you have a $20,000 roof and it's halfway into its life and it gets hailed on. Well, they're not going to pay you the $20,000. They'll pay you whatever dollar value of remaining life. Like basically apply a depreciation process to it. So if you get replacement cost, you don't have to do that. It just is whatever the replacement cost is. But cash value does factor in depreciation. So depending on the type of insurance you're buying, right? Obviously, if you get replacement insurance, it's going to be more expensive and maybe not always available. And there's another sort of factor here in that you often have to co-insure, and you have to make sure that the amount that you are insuring for is comparable to the replacement cost. So here, this is why this is relevant. So let's say you had a property that was worth $200,000. A bunch of time passes, and then you have $100,000 of damage to it, and your policy was at $200,000. So you'd say, oh, well, I have $200,000 coverage, I should be good. Well, no, not necessarily, because, right, if you didn't up your coverage, your house could be now $400,000. And so really what the insurance company is going to say is they'll say, oh, yeah, so basically 25% of your house broke, right? It's a $400,000 house. You had $100,000 of damage. So you have a 25% house breaking experience, and so we are going to pay out 25 or 50% of the damage, right? You'd only get 50%. You don't get $50,000, right? So that's why you have, right? So you have to maintain coverage at the replacement rate in order. Even if you're not damaging anywhere close to your replacement rate, there's this percentage thing that gets applied. So the point is you got to maintain coverage at the replacement value of your home, and that means updating it on occasion. So there's lots of different. Okay, so not all different things that can happen to property are insurable. So earthquake insurance might be available. Flood insurance is almost never privately available. It's only available through the government, and it's controversial even then because basically it doesn't make sense from insurance because people all get flooded at the same time. So as an insurer, they just can't do it. And the moral hazard problem is pretty severe, right? Why are we building in places where flood is risky? And if the government is willing to step in and provide flood insurance, it's just going to exacerbate this problem, right? So, and the classic case is people building on eroding coastlines because they like the view, and then they can just push whatever flood costs onto the government when the cliff washes away and their house falls into the sea. So there's different types of disasters get different treatments. Flood is the biggest one though, just because you can almost never get it. I worked with a property management company that had a significant flood event, and it filled a whole bunch of basements with mud, but it wasn't like a community-wide flood at all. It was just like this one random park got a lot of rain, and so there was a mudslide in this one park, and it went across the road and got like 4 apartments or whatever. And but regardless, it's flood, so it's not covered. Even though it wasn't like a big, huge disaster flood, it still wasn't. So, So all right, title insurance is if you buy a house and it was actually fraudulently sold to you, right, or they didn't properly have title, then title insurance protects you from that. It's a one-time fee you pay when you transfer the title. So it'll say, oh, and often, right, the previous person will have had title insurance too, and so there's like a chain, and but you're right, it's a big deal. Again, you can think about it from the perspective of someone doing a mortgage. If I'm putting a mortgage on a property, I don't want to have a mortgage on a property that I don't actually own, right? If the title ends up being encumbered by something, then I'm a bank, I can't collect on it. I'm really, really hesitant to do mortgages on properties that I don't know the title is in the clear. And so a title insurance gives the bank reassurance that they can lend against the property, because if there's a title problem, then it's the title insurance company's problem, not the bank's problem. Personal property is often included, but there's limits on the coverage. A floater covers named items, so this could, so you might have, for example, if you have I had a good friend who had a first edition copy of the Book of Mormon. He didn't personally have it; his family did, though. So that particular item had a large cash value, even though broadly they didn't. They didn't have a bunch of personal items worth much, but they just had the one thing. So you can imagine having that specifically written in to cover that one item. So payments for reimbursement are not taxable, and it makes sense. Or you don't have any. There's no income there. You had a loss, and then the loss is made whole by the insurance, and you're generally paying insurance with after tax money anyway. At least this kind. So. Now, if you aren't insured, the losses are tax deductible past certain amounts. Again, with the big standard deductions, now that's less relevant. But all right, so that's property insurance. Automobile insurance, you're probably very familiar with. Key parts: you have liability, medical, and damage. So, right. You smash up your own car, you get money to get it fixed. You smash up someone else's car, you get money to get their car fixed. You smash up your car and get hurt, so then you have medical care. You smash up their car, they get hurt, they get medical care, and so on, right? Oh, and right, you smash up their car, they get hurt, they get medical care, and they sue you for pain and suffering, and get awarded, but it's your insurance company that's paying the award. So there's lots of, I already went into, right, custom paint jobs can affect this. Lots of things can affect the cost of auto insurance, but the basic idea is, right, if you can establish that you're a safe driver by lots of different criteria, then you'll get cheaper. Credit score or something like factors in here, right? If you have a low credit score, you tend to file more claims, and so that makes insurance more expensive, stuff like that. Also accidents, right? So accidents drive up prices. No fault insurance does not assign blame for an accident. Each person is paid for damages by his or her own insurance carrier. This might, I'm not super clear on this. This might be mandated by some states. Often you can get in weird situations, and this happened to my mother-in-law, where she had State Farm insurance, and the person who hit her had State Farm insurance, and so State Farm was suing State Farm in California State Court to figure out who was going to pay. But it was all State Farm, so it was just silly. But I guess you have like Arm A and Arm B, and they wanted to use the courts to figure out which, who had to pay. So at the end of the day, I guess the no fault approach gets around a lot of these issues. I'm not sure how often it's used, but I mean it might be something that could be state mandated. I'm not sure. Okay, so liability insurance. This is third party coverage protects you against having to pay for a variety of losses to others. So, right, somebody is they're at my house, they're jumping on my trampoline, they get hurt, and they sue me, then then my liability insurance might cover that. Um, so, right. So then, right. So this kind of thing can, right. I might have injured somebody, or one of my family members maybe did, or stuff I was doing, right. My personal operation, maybe my like sole proprietorship business injured somebody. Right. Lots of different ways you can, end up having a liability issue, and so liability insurance covers that. So comprehensive personal automobile policy covers bodily image to others from automobiles, but there are other ways people get injured than just by cars, right? So that's where I have an umbrella policy that partly is meant to address this issue, that you might have other kinds of liability that would then be covered. All right, this is separate from right. So this is separate from, you can have professional liability insurance too. So you're a physician or attorney or something, and then you get coverage in case you get sued for malpractice. And in some medical professions, that insurance can be quite expensive. So umbrella insurance I mentioned briefly before. So this is excess liability. It often, right, the idea with the umbrella part is that it's covering things beyond the limits. So your homeowners or your auto might have a dollar limit, and you get sued for more than that. Then the umbrella would kick in if you had one. It's really, really cheap, and there's like quite a bit of peace of mind to it. But again, it has to be a pretty catastrophic event, right? It's not only do you have to have the bad event occurring, but it has to be so bad it exceeds the coverage limit of the insurance you already have in place, which is often could be quite large. But so yeah, you can have minimum 1 million, and then you pay for each million beyond that. And so it's useful. It's useful to have. Again, because it only covers in these really extreme circumstances, it can be pretty cheap. Okay, so let's talk health insurance. So there's lots of different kinds of health insurance. In general, we're talking about paying for medical care when you have a surprise bad health outcome. Right. So my son had a random bout of pancreatitis in the middle of his summer camp, so he had to get ambulanced to the little rural hospital, and then ambulanced to Mayo Rochester, and then had a day and a half of hospital care. So that all of that is not cheap, right? That adds up to a lot of money, and it's right. If that was just coming right out of my pocketbook, that would have been a huge financial disaster. But through health insurance, it was fine. I mean, I had to pay my deductible, but you can kind of count on paying that anyway. And at least in my current, right, I've got really great insurance right now. So I mean, I do have a core insurance. I think it's 80/20, but then the out of pocket, there's an out of pocket maximum that's very reasonable. But these are all things to know when you're thinking about shopping around different kinds of insurance, is how all those work. So major types of providers. So Blue Cross Blue Shield is it's an alliance of a bunch of independent insurers. So it kind of is a way to say, okay, we're all going to get together and sort of form a network. And so your individual Blue Cross Blue Shield provider might change depending on what state or part of the state you live in. And people working with those insurers can kind of know generally what to expect. There's different types of insurance that cover things in different ways. So HMOs are increasingly utilized for cost savings. Just as an example, in my previous job, if I was willing to do the HMO policy, my out-of-pocket monthly insurance premiums were like $300 and some bucks for my family. If I wanted to go the PPO route, it was like $1,200 something. So it was literally $900 cheaper for me to do an HMO than a PPO, and the HMO had better coverage percentages. So what's the downside then? Why why would you ever want PPO when you can HMO? Well, with HMO in general, you have a primary care physician that serves as a gatekeeper to getting specialized care. So if I feel like I'm having a skin issue, I can't call a dermatologist. I have to call my PCP, have an appointment, and my PCP says, "Oh no, this is just an allergic rash. Use some Benadryl. I'm not doing a referral for this," and then you just can't get it, right? So they will literally tell you no. PPO, the rationing works more by, well, you're going to have to pay 20% of this, and you're going to have to use it in network, right? And in a POS system, then you tend to have a gatekeeper PCP as well, right? So that's kind of the big difference. With PPO, you have a lot of flexibility in how you choose to use care. You can be in network or out of network, and you really just have total flexibility. But that flexibility comes generally with higher costs. With my current employer, we don't have an HMO option, so you're just end up having the flexibility no matter what. But it depends, right, on what employers have to offer. So no matter what, all three of those types include medical expense policies for doctors, non-surgical costs, whether in or out of the hospital, basic hospital costs such as room, board, and ancillary services, and surgical policy to pay for surgeons' costs, right? So you can just think about all the different, right? If you're in the hospital, they cover the food you're eating, and they cover that you're in a bed in a room, or you don't get like a separate hotel cost because they're sheltering you. But right, if I stayed overnight when one of my kids is delivered, and I got a meal that first night, so my dinner was not right. I had a separate bill for my dinner, but everything else was all folded into the medical stuff. They're used for expensive care and provide broad coverage, these major medical policies. And they have high maximum payments allowed. So I guess there's medical and major medical, right? And in major medical, you get it's kind of a stronger. You get you get bigger policy limits. It goes out to higher dollar values and covers more things. So differences in different policies. So if you're given the choice, right? So I literally don't have a choice. Other than going out into the Affordable Care Act marketplace. So I just have the options that I'm offered by my employer. But if you're in a position where you're given choices, like I was at my previous job, things that can matter. So deductible, co-payment, and co-insurance clauses, right? So the HMO version of my plan, I think it was $35 every office visit, and then $65 if you went to the ER or something like that. Whereas the PPO was a percentage, right? So the co-insurance. There was no co-insurance with the HMO model, and I don't remember if they called it co-payment or co-insurance, but it didn't matter because you had a fixed dollar amount under the HMO model, and it was variable under the PPO model. But it was not as easy to get approved for services. I had to work through a PCP and then a primary care physician, and then I think the pharmacy for my two options was the same, but you might have different prescription drug costs under different insurances. And you might have different things they don't cover, different limits on how long you can take the insurance, right? Lots of different dimensions, but the biggest ones are co-payment and approval, because it's obviously really annoying to have to pay 20% of a $40,000 baby delivery. And it's also really annoying to have a medical problem and have your primary care physician tell you no. So those are both big things to pay attention to when you're helping people decide on health insurance between options. But again, you may not be in that position all that often because frequently people get it through their employer and have no choice. Disability insurance. So disability insurance is for when you have you're no longer able to work, and right, if you're not able to work, you can receive a monetary compensation for that. There's two versions, short term and long term. So short term just gets you through recovery from like an injury, where you fall off a ladder, you're laid up for a couple of months, and then you're back in business. That's short term disability, and a lot of employers provide short term disability through like sick days or things like that. Long term disability is different. This is like, say I get a stroke and I can no longer be a professor because my speech is slurred and I can't keep track of things. Well, then I would have to be I would need a way to financially support my family outside of my career, and that's what that would serve. So the definition of disability is important. So the strongest definition is own occupation. So this would be, right, if I am a professor, if I have an own occupation disability insurance, if I can no longer be a professor, I collect, right? It doesn't matter if I become a web programmer and do front-end web design and end up in a more lucrative career than I had before, because I got my own occupation pay. Whereas if I don't have own occupation, the disability will say, oh, can you do literally anything, right? If you can do something, right? If you could reasonably work, just not in your old career, even if it's a lower salary, they might not pay anything, right? So own occupation it's an important description, and obviously if you get own occupation, it's more expensive. So you might have multiple layers, right? So you might have own occupation from one that you buy, and then you might not have own occupation on one provided through work. I mean, who knows? So there's lots of different things. It's just an important thing to know whether or not you have it or not. And then, so that's important, the definition of disability, the elimination period, like how long do you have to wait before you start getting paid, often 3 to 6 months. Because they want to know, is this short term or not? But a residual benefit, right? If you end up coming back to work at reduced pay, do you get some benefit, to make up that difference? Excuse me. Does it cover pre-existing conditions? Does it cover rehabilitation? All these things are relevant. Is it adjusted for cost of living, right? As these go up, right? Is this indexed to inflation? In general, you're limited. You're not, because they don't want people abusing the system, you're generally limited to be significantly less than you were making before. There's also really weird taxable things. So if you paid your disability insurance with after-tax money, then the disability benefit is not taxable. If your employer paid it, then they generally didn't pay with after-tax money, and so your disability benefit is taxable. If you had, and if you mix it, right? So what if they pay some and you pay some? Well, then now you are partly taxable. So that's kind of complicated. But the general idea is you always pay tax. Either you paid it as income taxes before you paid the premiums, or you pay it as income taxes after you're receiving the benefit. Social Security system also has a disability insurance. You have to be unable to work for at least 2 years, or if you're terminal, right? So, and they're right. Basically, these are long-term disabled folks, right? So I've got a good buddy who has chronic fatigue, fibromyalgia kind of stuff, and so it really prevents him from having any kind of career, because it totally exacerbates all of his health issues when he does really much of anything. And so and for all practical purposes, with his health, he can't work. And so Social Security disability provides financial support for him, because he really can't, is physically unable to provide for himself. So you have to have previously been in the Social Security system a little bit, and all right, so there's all sorts of requirements, but there are a lot of folks are on Social Security disability and use it to survive despite their inability to work. Long-term care insurance. This is we call these nursing homes, right, or assisted livings, right? So this is I'm old, I need constant care. Or I'm in ill health, I need constant care, and this is really, really expensive, And so I have an insurance policy in place so that when this happens, rents in these facilities can be $4,000-$6,000 a month, and so that could eat through somebody's savings pretty fast. So if you have long-term care insurance, that's a way for a certain period of time, maybe 3, 5, 6 years, where they will pay all of those monthly premiums so you can get in a good care facility that's high quality, and that's something you might pay ahead of time. So maybe in your 50s and 60s, you say, well, it's looking like maybe I'm going to live a long life and I'll be into my 80s and 90s and potentially need care. Let's start paying into this long-term care policy so that I'm taken care of when that arrives, and I'm not an undue burden on my kids or whoever would be needing to be taking care of me. So that's that's what that is. All right. So government insurance, there's lots of different. There's at least 4 we mentioned. Social insurance is insurance provided by governments, right? And there's we can think of a couple. I mean, there's lots of these, right? So you have public assistance for housing. You have retirement, or like a pension. You can have medical assistance. You can have so there's lots of ways. In general, common in developed countries that we have payroll withholdings that then ultimately come back as medical or pension. And the idea is then you don't have adverse selection, especially for old age medical, right? So there are a small percentage of the elderly generate a ton of medical expenses, and if insurance companies could figure out who they are, or even you can imagine using pre-existing conditions, right? It would be almost impossible to get medical insurance. And so since everybody's in a big group, right? In the U.S., everyone's 65 or older, you're just all in a big group. Then you kind of gets rid of adverse selection because everyone's in it. There's no selection. No one's selected. We're all in it. So it gets rid of that problem. The main ones are Social Security, workman's comp, disability, and unemployment. So workers' compensation, it provides if you are disabled because of work-related activities. So again, right, so think about, we talked about disability insurance already, but that you could become disabled because you had a stroke or because you had an accident at home, right? So workers' comp is specifically for injuries at work. And this matters because the rates that employers pay for workers' compensation insurance depends on how many claims they have against workers' compensation insurance. So that if they make their workplace safer, they can reduce workers' compensation claims and make their that insurance cheaper, right? So, but again, if you're hurt at work, then you have workers' compensation step in that helps pay for your recovery and covers your loss of income during the time. And if you are killed by in a work-related accident, then it provides a benefit to families. But again, it's all work-related, right? So that's the big difference compared to the private insurance. Businesses are required to participate, right? So if you have workers and you're past a certain size, you have to do it. So that's one. Medicare, right? This is medical coverage for people age 65 and over. There are so there's deductibles and maximum payments, but in general, it's very, very good, right? So you have Part A, and then Part B supplements that, and then there's also a pharmacy plan, but basically you can almost count on using Medicare at age 65, and the private insurance is just then functions as supplemental to that. Medicaid is administered differently. So Medicaid is at the state level, and you actually, there are private insurance administrators. So if you are on Medicaid, you might be able to pick between different insurance administrators, and right, it's income based, and those income standards change from state to state, and different states fund it to different amounts. So it ends up being administered very, very differently, but at the end of the day, it's healthcare coverage for people who can't normally afford it. and it has pretty specific rules. For example, I mean, you're never ever allowed to send a Medicaid patient a bill for anything. I think you can get in big trouble if you try to charge a Medicaid patient money. So they have to be very careful not to do that. And I think in your book it says roughly, I mean, it's like, I think 15% of Americans are covered through Medicaid. So it's a pretty large insurer. Unemployment. So this has come up recently with COVID. They, lots of sudden, right, biggest unemployment claims in any week ever by some huge margin last week. So lots of people filing for unemployment right now. And what does it do? So this is insurance. If you lose your job, you can file for unemployment insurance, and it pays some financial support while you are searching for a new position. So you're so you're looking, and you're collecting payments. It's generally nowhere near what your job was before, but it's a little bit helpful. And the idea is to just get you through the period of unemployment so that you can get back employed and get back in a good financial position. This is important. You can't, or if you're fired for cause, you can't collect unemployment, right? So if you were stealing from the break room and they catch you and they fire you, you can't fire unemployment. Also for a labor dispute, right? So if your union does a strike and then you get replaced, that's part of a labor dispute, that would not then qualify either. Generally it's 26 weeks, but it's it gets extended, which I haven't heard, but I'm assuming they're talking about extending unemployment insurance during this like economic crisis here. Social Security survivors benefits. So as Social Security, you collect in retirement based on how much you paid in, but also if you die, your survivor is able to collect as well. So a spousal survivor, right? So surviving spouse, surviving kids up to age 18, elderly parents who are supported by the wage earner, right? So it's kind of like if you think about immediate family, can collect certain percentages based on certain levels, right? So a widower, one dependent, you get different percentages. A widow's benefit is different percentages. But again, the idea is there. Social Security is it does something at various levels for the people the wage earner was providing for, right? So Social Security is funded by payroll deduction, so that person was presumably providing for a family unit of some kind, and so that that family unit after that person's death still needs to be provided for, but maybe at a reduced amount because they no longer need support, but their family might. Okay, so that's a big picture summary for all the different flavors and versions of things that you can bring to bear to insurance things to bring to bear when working with clients and their risk management. Again, big picture, right? Not everything needs to be insured. What needs to be insured depends on their risk profile and depends on the overall risk management perspective for their whole total portfolio. This is that total portfolio management approach again, where we think about everything, right? I mean, if you've got millions of dollars in stock, you probably don't need to worry too much about insuring these things that have a $1, $2, $3, $8,000 loss, but that liability coverage, the $1 million liability policy, now becomes a lot more important, right? So it's important to carefully tailor the risk management approach to the needs of the individual clients, and there are lots and lots of different options to get there. So thanks.